Good morning or good afternoon, depending on where you're joining us from, and welcome to Nature's Returns, Investing in Ecosystem Services, a webinar series hosted by the Yale Center for Business and the Environment. My name is Corey Scalt, and I will be your host for today's presentation. As many of you know, the Nature's Returns webinar series addresses the growing importance of ecosystem service valuation and investment. Each presentation is recorded and available from CBay through our YouTube account and the Yale iTunes U channel. Today, we are having a discussion about sustainable farmland investment strategies and how environmentally responsible management, infrastructure, and production practices can aid the pursuit of market-level financial returns. Our guests will explore the various opportunities for every profile of capital, from venture capital to foundations to family offices, to generate returns from investing in sustainable agriculture. Joining us on today's webinar are Lucyann Murray, Megan McGrath, and Stephen Hohenrieder. Lucyann is a third-year joint degree MBA and Master of Forestry candidate at Yale University. Her studies focus on sustainable land management and investment, and she spent this past summer evaluating new investment strategies at the timber investment management organization, Greenwood Resources. Lucyann's interests lie in finding innovative ways toward a sustainable future in land and natural resource management. Megan McGrath is a senior associate at Agriculture Capital Management. She's interested in developing solutions that improve environmental health and enhance natural resource management. She has a particular interest in using financial tools to advance working landscapes and improve water resource management. Megan has helped manage $20 million in Change, Patagonia's internal venture capital fund, has worked with Sonin Capital, a socially and environmentally focused investment firm, and has worked at Blue Earth Consultants. And Stephen Hohenrieder is an entrepreneurial private equity investor focused on helping to build companies along the value chain of our food system that also promote more regenerative land management practices, enable the production of more healthy food at scale, and connect people to each other. Beginning with an agricultural background, Stephen has invested diverse capital in land, agricultural production, processing, storage, consumer products, technology, and vertically integrated food companies. Stephen currently consults for 2 private equity firms, is advising 3 companies, and serves on the board of directors at Food System 6. Now, finally, before getting started, I'd like to remind our listeners that there will be 15 minutes for question and answer at the end of the session. We encourage your questions, and you can type them into the Q&A section of your screen throughout the presentation. We will collect them throughout the presentation and present them to our speakers at the end of the program. Now, without further ado, I'd like to pass things off to Lucyann to talk about the report that she and Megan recently published. Lucyann?
Corey, thank you so much. We are really excited to be here. This report has been about a year in the making, and it kind of pronged from 2 interests. One was personal. Megan and I are both very interested in various aspects of the food system, and we're interested in how to feed the world and save the land while doing so. The second reason is because there's been a rise in farmland investing over the last 40 years, and it's given a return of 10.7%, which is showing to be higher than the S&P 500. So we wondered about sustainable agriculture, which is part of this, but also a little bit separate, and a fast-growing body of scientific research has showed that sustainable agriculture can prove returns. So currently $294 million of USDA research funding is supporting these projects. So we wanted to look at sustainable farmland to determine if it was an adequate strategy for investors. So this paper is based on that, and it explains recent trends, and it's intended for investors and land managers. So the main question we approached was, do sustainable farmland investments deliver financial, environmental, and social returns? If yes, to what extent, and how are those returns realized? Sustainable agriculture here is defined as the production of food or plants using farming techniques that protect the environment, promote economic profitability, and provide social and economic equity. Some of you may be familiar with this. It's in the USDA definition. So to get there, we found that there was a limited amount of literature available. And we did a literature review, but we also wanted to do expert interviews. So we ended up interviewing 10 firms, which are listed on this slide, Agriculture Capital Management, where Megan is working, being one of them, and Farmland LP, Stephen's former firm, being one of them as well. And we asked each of these stakeholders about what was important to them, what the perceived sustainable agricultural opportunities were, their financial and operational strategies, investment vehicles, motivations, value drivers, performance monitoring, risk management, and industry challenges. Our data are, as you can see, 10 firms is not that much, so our data is a little limited in terms of size, and we also found that a lot of these firms were really young, so our data was also limited in terms of age of the data. However, despite that, we ended up finding that sustainable agriculture strategies were a promising strategy for investment. And the two theses we found in this were that investors were looking at efficiencies and improvements, particularly those related to ecosystem functions, because they enhance performance of the underlying asset. We also found that investors thought it was financially attractive to meet the growing demand of natural and organic industry. This table on this slide shows what was enticing about the efficiencies and improvements. There were improvements in ecosystem services, farm infrastructure and scale, and farm management. Some examples are included here, and you can find more examples in our report. But for instance, no-till farming or cover cropping could lead to reduced costs or increased resilience. So our key findings within those various questions that we asked, we found that a lot of the investors were driven by price premiums, market access, lower costs, risk mitigation, and consistent yield. I just mentioned our investment theses and strategies. And the management models looked at an owner-operator. So were they directly managing the land, or were they leasing out the land to another party to manage? We noted that public incentives were not a significant component, and that investment performance targeted a 9 to 15% IRR, but we couldn't draw significant conclusions here because, as I mentioned, these firms were pretty young and didn't have a lot of data tracking. There were a number of challenges and risks that we encountered and that a lot of these firms have encountered, some of them being access to capital, sophistication of the land managers. It's really important for those who are managing the land to have knowledge because it is not the status quo at the moment. And like I just mentioned, there was not a lot of performance tracking, so a good way to track performance. Overvaluation of land was really hard too because some investors didn't want to participate, and a lack of supportive regulation. So ultimately, this was really positive. We found that sustainable farming in these investment firms were able to deliver returns, but we weren't quite able to define what those returns are. So looking in the future, it's important to invest in data collection and monitoring to make those connections between asset performance and sustainable activities. And it's also important to conduct a comparative analysis to understand how those strategies compare to conventional strategies and if it's actually providing a premium or not, and to assess the viability of additional social and environmental revenue streams. This could be carbon markets, etc. So I am going to hand over the presentation to Megan because we actually found some really exciting case studies that we want to share with you that show what was positive in our findings. And Megan was also a joint degree, and she co-authored this paper with me, and she graduated from the MEM MBA program at Yale last year.
Thank you, Lucyann. Good morning, everybody. So the first case study that I'm going to talk about is related to holistic plan grazing. And so what that is, it's an alternative form of livestock management in which managers divide the land into smaller paddocks and group the animals into herds that are rotated from paddock to paddock. And this is done in order to maximize soil and grass health. So it's really an attempt to strike the balance between the consumption rate of the herd and the growth or recovery rate of the grass so that you're moving and optimizing for that. So this type of grazing can increase soil productivity and produce more nutritional grasses and greater volumes of growth. And what that means for the business side is that it supports higher stocking rates and reduces input costs, and it can reduce the risk associated with the volatility of those inputs. One manager that we spoke with was able to increase stocking rates by 75%, which certainly has benefits to top-line revenue, and also observed overall herd performance when compared to the neighbors during drought years. So this manager was able to achieve a 7% cash return over the 5-year lifespan of this particular project we worked on. And Stephen also has some experience with this, which I think he's free to jump in now, or maybe when he talks later, can provide kind of some more examples to this regard as well. Another example that we looked at was related to investments in resource efficiency. So as Lucyann mentioned, there's still limited data connecting the investments in sustainability strategies with their performance. However, one manager we spoke with, TIAA, has been particularly advanced in reporting on their ESG metrics, and really when it comes to investments in water efficiency. So what that is, they've realized that by investing in improved water management, they've been able to realize benefits in the form of lower costs, improved risk management, greater resilience, and competitive regional performance. So certain activities that are included in investments in water management include precision land leveling, erosion control, low pressure irrigation systems, wastewater recycling, and smart irrigation technologies. And these have been shown to improve water efficiency by up to 25%. So looking at some of TIAA's properties, this has meant a reduction of 65% in overall water costs and a 75% decrease in dependence on water withdrawals, which is particularly important in regions where drought stress is an issue and needs to be mitigated, like in California. Additionally, at the properties in Brazil, they noticed that during drought, their properties only experienced a 5% decrease in yield as compared to neighboring properties, which averaged a 12% decrease in yield. Additionally, in some of their properties in the southern United States, TIAA has observed a 50% decrease in water use for crops like rice. So really, there are a lot of opportunities, particularly when it comes to water management and tracking the performance. Another aspect we explored as part of our report is this idea of going beyond organic. So there's certainly price premiums that one is able to achieve related to organic certification, but we've observed that other managers are able to increase those premiums even more by certain beyond organic activities. Another challenge managers have to address is a scale challenge. And we spoke with one investor who's been very creative in combining these two ideas by aggregating the smaller parcels that they own into one management regime. The staff are then able to scale the efficiencies across the entire portfolio. And they couple this with innovative lease agreements that allocate a certain number of acres to their tenant farmers. And so this allows the management to employ a rotational model that maximizes the soil health and fertility of their land and allows the tenants to farm high quality land. And they've been able to realize a price premium of up to 20 to 40% above regional land rents, which is very significant. So there are creative solutions out there to achieve the scale benefits and attract compelling price premiums. And now I'd like to hand it over to Stephen, who can provide some more information and perspective on these sorts of activities.
Thank you so much, Lucyann and Megan. This is Corey. I'm just jumping in quickly. For those of you just joining us, Lucyann Murray and Megan McGrath just presented on some methods, key findings, and then 3 case studies from a report that they just recently published on sustainable farmland investing. And now for the next 15 minutes, Stephen Hohenrieder will add his perspective for many years of investing in all parts of the agricultural supply chain. And we've had many interesting questions coming in. Thank you for already submitting those. Again, you can submit your questions through the Q&A chat window available through the Zoom webinar platform, and we will begin addressing them in about 15 minutes. Stephen, welcome.
Thanks, Corey. Good morning, everybody. So we thought it might be useful to go through a few examples of investments that I have been part of with other teams and identify some of the observations and lessons learned in doing so. At a high level, to echo some of what Lucyann and Megan have mentioned, the opportunity to invest in sustainable farmland and ranch land has evolved, especially in the last couple of years, to a point that you're starting to see much more conventional investors come into the space, which in many ways I think is very exciting and is validating some of the work that we've all been doing over the prior years. Part of what's driving this is a shift in the consumer and the consumer's relationship with food, which seems to be valuing attributes in their food that look more like they did before industrialization than after. And by that I mean not necessarily local or organic, but valuing a connection to the source of their food and transparency and authenticity in the supply chain of that food, all of which drives a more fragmented food system. The demand we're seeing from the consumer has far outstripped the supply of inputs. Speaking of organic food, generally, the majority of it's being imported into the U.S. just because there isn't enough domestic supply. I happen to be helping launch an organic sugar company right now, primarily driven by the thesis that there's incredible demand for organic sugar that's produced domestically in the United States, but there's basically none produced in the U.S. It's almost virtually all imported except for one small amount. So as we look to opportunities to get exposure, there's a place for all different kinds of capital. We've seen a lot of private capital coming into sustainable agriculture in the form of impact investments. We've seen philanthropies such as foundations and other groups look at ways they can help reduce the cost basis on land acquisitions to make it more profitable and also achieve the objectives of those organizations. And we're seeing increasing public support for these types of investments, not only because there's a market demand for it, but also a lot of the people whom we have been working with in public policy realize that it benefits their political career as well, and it's supportive of their communities. So as we think about how people are deploying capital into these assets, Lucyann mentioned the importance of identifying people or managers who know and have experience in what they're doing. And that probably sounds obvious, but we so often see impact-aligned investors foregoing some of the investment criteria they might normally use in deciding who to use to get that exposure. And so we try and encourage everybody to make sure that they set expectations ahead of time about the exposure they're getting, whether it's land or crop exposure or infrastructure exposure or even technology. And these assets all have such different return profiles, even within land and production. For example, owning row crop land has a very different life cycle and return profile than permanent crops. And each of them provides different opportunities to drive regenerative practices and impact. And I guess one of the big things that I have observed over the last 6 or 7 years is a propensity to want to invest in the perfect. And a lot of capital that has more regenerative motivations is oftentimes wanting their capital to represent what the world should look like and can look like, rather than deploying capital into assets that they may not be totally comfortable with, but that have some scale and have levels of production that actually allow them to have a much larger impact than they might with a small test project. So to quickly walk through a few examples, and I'll breeze over these and try to highlight some lessons learned. And then in the Q&A or afterward, if anybody would like to dig deeper into any of them, I'm happy to get into as much detail as anybody wants. So about 6 or 7 years ago, I decided to spend all of my time investing along the value chain of our food system to understand where we can deploy capital, especially in land and production, in ways that describe the things that Corey mentioned. And there have been a few very consistent themes through the handful of investments that I've been part of leading or significantly involved with. And it began with an acquisition just south of San Jose, about 20 minutes south, something I'm actually still working on 6 years later. And that probably highlights something that is important in doing this work, and that's patience. And being willing to look at a lot of different opportunities and understand the life cycle of these deals. This one is particularly special to me, but it also is particularly difficult, and it's required a lot of collaboration among different parties. But it's 6,000 acres, and it has a 200 million ton sand deposit. It has incredible grazing land. It has agricultural land. It has a large underground water aquifer. The state of California, in some ways, identifies it as the most critical point of wildlife connectivity. But out of all of that, what really came to bear was the need to look at each one of these pieces of land as a system. And if we were just looking to buy it to graze cattle and employ more holistic practices, it wouldn't work. If we were just looking at it for the habitat value, it wouldn't work. So being willing to look at all of the different elements of value in that land, which may not even be highlighted in the sales process, but that need to be identified by the investor, are critical to figuring out how to not only develop a investment that makes a lot of sense financially, that can also drive a heck of a lot more impact than you might be able to through any one activity. From there, I was joined a partner, and we acquired something called the Hana Ranch with a team. And we chose, Hawaii was interesting to us for a number of reasons. And I think one of the most important elements of making decisions about where you're going to get these types of exposure, especially in sustainable agriculture, is to make sure that not only do you have a market for the product, but do you have a community that's going to support your activities, even if you need to bring them along in order to succeed in not only getting the deal done, but also in achieving your objectives. Hawaii was interesting to us for cultural reasons. They're very aligned with the philosophies of more regenerative agriculture. It's a place where there was some margin for error. They're paying real world prices for their food, for their water, for their energy. And so we ended up acquiring the Hana Ranch, which is an old sugarcane plantation that years ago was turned into a more of a lifestyle property and a cattle ranch. We acquired 2 water companies that were sourcing water off of the ranch and delivering it to that side of the island, which was common back in the plantation era. Most of the water companies were owned by the plantations. And we also bought an interest in something called Maui Cattle Company, which is a meat packing and distribution co-op. And the idea was to make an acquisition on behalf of aligned capital. We had one investor for this acquisition, which was a family on the East Coast, and to really push the edge of regenerative practices and see what was possible in building a vertically integrated farming and ranching operation, with the goal of first feeding Hana, which is an isolated town on the east side of Maui, next feeding the island of Maui, first feeding the town of Hana, then feeding the island of Maui, and then the state of Hawaii as we ramped up. We partnered with one of the other organizations that Lucyann and Megan mentioned, Grasslands LLC, which is part of the Savory Institute. They staffed our livestock foreman. And we set out to build this vertically integrated operation. And it was an incredible experience. A few lessons that we learned in doing so were, for one, most of the financial returns on these land-based acquisitions are defined in the acquisition price. And that may sound obvious, but so often we see people acquiring land at a premium with the hopes of being able to add a lot of value through more sustainable practices. And I would suggest that you have to use very conventional methods in valuing the property, and the sustainability or the regenerative practices that you implement really are upside and can address the consumer market. But this was evident for us in Hana. Like any other asset, it's really important to understand the market and understand the community that you're going into and understand the seller. Agriculture is very different than any other asset, and especially the types of agriculture that we've been looking at, which is in production and typically not owned by an institution already. Money changes hands in these investments, in these acquisitions, but the deals are about everything other than the money. There could be a generational transition. It could be financial distress. But we have found, I have never been part of an investment in these assets that isn't about something other than the money. And it's very emotional. And also, and this is extreme in Hawaii, but it was a lesson that we learned in other communities as well, that when you come into these communities with the best of intentions, and in some cases those intentions aren't well regarded in more conventional farming environments, that you're coming into somebody's community and they will almost always be skeptical of your intentions and be worried about you changing the community that they live in. So having the empathy and the awareness that this is going to influence your deal process is absolutely critical, unlike acquiring a middle market manufacturing company or even commercial real estate that is already a very transactional market and institutionally based. One of the statistics that we've used in the past is there's $2.4 trillion worth of farmland in the United States, the same as all of the office buildings, but only 1% of farmland is institutionally owned. So you have an incredibly fragmented market that is good and it's bad, or not bad, but creates its challenges. Once we had Hana up and running, I was focused on looking deeper into the beef industry, and given the barriers to entry, given the state of the industry, given the amount of land that's required in order to produce beef in what I believe are regenerative ways or in sustainable ways, and have now for 3 years been working with a vertically integrated beef company in California called Prather Ranch. And Prather grazes animals on 30,000 acres in Northern California. They finish the animals at the headquarters ranch. They don't actually finish on grass. They finish on dry farmed barley and rye because they need to slaughter the animals year round, and they can't finish on grass year round. Which is one of those elements of things not necessarily being perfect. And in an ideal world, it would be great to be able to finish on grass all the time, but they're not feeding corn, they're not feeding soy, they're not having to give the same antibiotics, and they're feeding a grain that is dry farmed, so it's not taking incremental water. But they slaughter the animals at the headquarters ranch. The carcass is then transferred to the Prather Ranch Meat Company. And the Prather Ranch Meat Company has developed channels through which they sell the meat, including wholesale grocery, retail, restaurant, direct through companies like Good Eggs, through a meat club. And they have about 25 value-added products and prepared foods that they sell. All of this is the result of 36 years of refinement. And the reason I bring it up is I often see people investing in agriculture and applying the same principles of capital allocation that you can use in other industries, where you can essentially buy time by applying more resources. And one of the things that is so interesting in agriculture is that really doesn't happen. You need cycles. So institutional knowledge is absolutely critical. And oftentimes, as I'm observing people investing in agriculture, and in particular sustainable agriculture, when they want to change the practices of an operation, they don't think about the importance of knowing what's been happening on the land for the last 10 or 20 or 100 years. And last week I was reading an article that I thought was so interesting, and one gentleman mentioned that his father was explaining to him why he is risk averse. And he described it as only having 40 opportunities to plant a crop in his lifetime, and the fact that he couldn't afford to get one wrong. This is changing, though, and it's changing for a couple reasons. Big ag has changed. The economics of farming have changed for commodity farmers, and they're hitting a pain point combined with a market that's created demand for different products, that we're starting to see a lot of farmers, and maybe it's generational, who weren't willing to take the risk to get off the corn and soy and subsidized commodity agricultural train, to take a risk and convert to organic, or take a risk and convert to food crops. And so I think it's interesting to see not only changes in ownership driving this, but also changes within existing operations. in the interest of time, I'll wrap up with Farmland LP, where we acquired an operation when I joined in the Willamette Valley of Oregon that was farming and had just emerged from Chapter 11 bankruptcy. And it presented an incredible opportunity to continue a legacy, but also continue an operation. And the acquisition was interesting for its scale and for what was currently being produced. But it was an opportunity to also keep 40 people employed, to take a operation that was not necessarily sustainably minded, although they were very open to it, and leverage that platform with a long-term perspective to that to organic production at scale. Once we completed that acquisition, we combined it with a farm management company called Vitality Farms that was already owned by Farmland LP to create something called Green Spring Farms that now farms about 14,000 acres in California and Oregon, and we'll be converting that land from conventional to organic during that time. We learned quite a few lessons in doing this. Farmland LP's model is to buy land, develop a rotational plan for that land, and then lease it out to farmers who need access to land. And it's a way to, if you think of maybe an office building, to aggregate a lot of different activities in an ecosystem that can, on its whole, provide synergies among the different tenants, if you will, but in agriculture also at scale drive fertility through a rotation. A few things we learned is if you're going to convert land from conventional to organic, it's very different than some of the sale leaseback models you might see with the public REITs or other companies, and it's very operationally intensive. And so as a investor, you have to be willing to get your hands dirty and comfortable getting your hands dirty. We also learned that where you buy these assets is important, because while a lot of people want to farm in these methods, they can't travel a long way to do it. So it's important, as you think about scale, to identify communities and geographic regions where you have enough demand for those leases in order to achieve the goal of leasing it out to others. And in the meantime, being operationally minded, you have the opportunity to farm it yourself. So takeaways from this, and we're out of time here. There are really broad opportunities to invest in regenerative land and production. The market is evolving quickly, and I think conventional markets are coming to more sustainable practices for a lot of different reasons. And as you think about impact, look at what is actually going on the ground. Organic monocrops aren't necessarily regenerative. In many ways, the practices that we see on the ground can drive fertility and are intended to drive fertility and support people. And that's not always the case with some of the operations. Invest in these assets as you would anything else. Start with a practical investment strategy and don't compromise that just because of your impact orientation. I view impact as an overlay of values in investing strategies in other assets. So find people who know how to invest in farmland and have a team that can achieve your other objectives that may be impact oriented. And then set expectations for yourself. What are you hoping to get out of this from a financial perspective, from an impact perspective, and what kind of time frame are you willing to work in? The time frames are very different in the assets that we're discussing. And oftentimes we see a confusion between philanthropic and financial objectives. And then lastly, I'd say that the opportunity is being driven by the fact that diverse stakeholders are all pushing our food system in the same directions for very different reasons. big ag and small farmers, food companies that are big and small, academics, landowners that are going through an generational transition, consumers, and lastly, investors are all driving our food system, in my opinion, toward a more fragmented system that is going to create opportunity for small and mid-sized farmers. There are some things that are going to happen to facilitate that, including infrastructure being built from the farm gate to the last mile of distribution. But it creates an incredible opportunity to deploy capital into these assets with more sustainably minded objectives.
Great. Thank you so much, Stephen, for providing your investors' perspective on experiences with deploying capital in these assets and building related businesses. We really appreciate your discussion of several representative investments and why you believe the opportunity is compelling, some lessons you've learned from your experiences, and how different sources of capital are participating. We're going to move into some question and answer so that the audience members can hear from Stephen, Lucyann, and Megan on some topics that they are particularly interested in, and we'll dive right in now. One listener was surprised to see in the report that public incentive programs are not a significant component of the sustainable farmland investment sphere, even given that a primary challenge is overvaluation in land markets. Megan, this listener was wondering if you could elaborate on this and maybe speak to whether investors are actually avoiding farms that have agricultural conservation easements on them that have been sold to the government, and if the sale of unrestricted land is a significant portion of targeted IRR.
Great. Happy to. And thank you for the question. This was certainly something Lucyann and I were both very interested in focusing on in the research of this report. And one thing to keep in mind that of the 10 firms we looked at, the strategies are pretty diverse. And so some are investing in large properties in the Midwest, while others are looking at smaller properties in densely populated areas in the Northeast. And I think across the board, we had a lot of interest from the firms that we spoke with. They were very interested in understanding how they could employ these public incentive programs, specifically conservation easements, but to date, they haven't really been widely adopted or proved to be an effective tool as they have been in some other similar sustainable farmland or sustainable forestry strategies. Internationally, we spoke with one manager who is involved in an equivalent program in the country where they're operating, but their motivation and reason for doing that was more to have a license to operate within that region, less about the financial bottom line. When it comes to other programs beyond conservation easements, looking at other partnerships with USDA, working with NRCS, again, a lot of interest here, but investors typically leave it up to the land manager to decide what's appropriate for that particular property. But we think this is an opportunity that warrants kind of more investigation to see what existing or future programs could be adopted into these strategies.
Yeah, and I just want to follow up on that. When looking in the forestry sector, it has started to take hold a little bit. There are certain companies like Lime Timber or Hancock or Conservation Forestry who are looking at putting conservation easements on the land. And the conservation easements, when the land is not at risk of development, is actually not affecting sale price. That is a situation, as Megan mentioned, that is a situation by situation basis, because certain strategies do sell some land for highest and best use of development.
Great, thank you so much for that. We're going to move on to another question. This one's about impact metrics that came from a listener. She was curious if you found that GIN, the Global Impact Investing Network, or IRIS Index on Sustainability Standards have played any significant role in helping to track and report metrics. And she was wondering, if not, have you seen a preference for other metrics or individual kind of farm-defined metrics?
Another great question. I think of the managers we spoke with, TIA certainly had a more advanced reporting program. They produce an annual report, which is publicly available, and that adheres to the UN principles for responsible investment. And they have kind of some categories that they regularly report on. But in terms of getting, to the details of really connecting the strategies with performance, financial, environmental, or social, it's still something that managers are actively working on.
I would also add that the appropriate metrics are so different depending on the asset. And so to really come up with measurable outcomes, I have encouraged people to develop them relative to their strategy or to the particular farm or ranch.
Great, thank you for the input. We have one question that's focused on socially responsible practices. This listener said, thank you for discussing environmentally regenerative practices, and was wondering if you've come across businesses or investment strategies that are interested in including socially regenerative strategies in their practices, such as intentional community wealth building, communally owned farms, pipelines to worker land ownership, increasing women's and peoples of color's access to land management roles, or any other things that focus on the social aspects, social impacts in addition to the environmental ones.
So actually, Equilibrium Capital, which is attached to Megan's business, or where Megan works, Agricultural Capital Management, that we were speaking with them about their investment strategies. And Megan, you can probably speak a little bit more about this, but I believe that when they are choosing land managers, they are purposefully choosing those with social missions. And I think that was a core part of our scope of who we looked at, was that they had a social, economic, and environmental goal. Megan, do you remember any of the specific social missions of the people we talked to?
Yeah, so ACM is working on creating vertically integrated, sustainable agriculture and food companies, and a big component of that is the social aspect. And what that looks like is when we acquire processing facilities and how we think about the employment on farm, we try and think about year-round employment. What are ways that we can create a more stable work environment for our employees? So that's kind of one realm of what ACM is thinking about. Additionally, we did come across a few managers who are thinking about land ownership and what the transition of land looks like in the coming years. And so one in particular who is operating in the Northeast is considering and employing some lease to own structures. So how at the, after 5 years, 10 years, can that current land manager build up equity in the property and at the end take over ownership of the land? So there are examples out there incorporating the social aspect as well.
Thank you both for providing a couple of examples. We are unfortunately running out of time, but we're going to try to squeeze in just a couple of quick more questions. One viewer was curious about industrial hemp. They asked, with the U.S. legalization of industrial hemp, there seems that seem to be outperforming the realities that the crop offers to the agricultural sector. They're curious what your vision was for funds and investors focusing on this crop in relation to an impact investing strategy.
Yeah, so of the folks we talked to, no one is currently looking at that. I don't know that much about it. There are a few funds out there who are thinking about cannabis as it becomes legalized. But I would guess that institutional investors probably aren't going to play in that space anytime soon. Nathan Hall, a current joint degree student at Yale, is currently working on these topics and might be a great resource. Stephen, I don't know if you have anything that you've seen related to that topic, but pretty limited from my perspective.
Yes, there's a lot of interest, both from people developing, even academics who are developing medicinal uses for it, and other more industrial purposes. But given the political aspects of it, most institutional investors have shied away.
Great, thanks. So people can get in touch with Nathan Hall for more details on that. We're going to wrap up with one more question. Stephen, this one's directed to you first, and then we can open it up. This viewer was curious. Stephen, you talked about the importance of vertical integration to farmers who are trying to improve their economics. And they're wondering if you could elaborate on the sources of revenue, whether there's an exit value in the return equation for those vertical integration propositions.
Sure. Well, if we think about the value chain of the food system and where the consumer is going today, there's an incredible opportunity, and we're seeing this on our farms, and I'm sure ACM is, and others. In fact, ACM is doing this at scale within their strategy. There's a wonderful opportunity to capture more of the retail margin by branding or adding value. And the consumer actually appreciates it and is starting to seek these things out. We're seeing a lot of evidence that the consumer is developing brand loyalty, even for fresh products, and for a lot of reasons that are understandable in terms of consistency of experience and some of the other elements of connection that we touched on earlier. So we're seeing farmers who are willing to take the risk be able to improve their margins by integrating vertically. And I think there's a wonderful proxy for where all this is going in looking at the wine industry and how we got from 300 to 10,000 wineries and the custom crush system that evolved to support smaller producers.
Great. Thank you, Stephen. So unfortunately, we have run out of time. We'd like to give a big thanks to our three speakers, Lucyann Murray, Megan McGrath, and Stephen Hohenrieder, for a rich discussion. To our listeners, the recording of this webinar will be available on our YouTube and iTunes channel, so please check in for that if you'd like to revisit any of the topics that were discussed today. To access the report written by Megan and Lucyann, please visit the Conservation Finance Network website, which you can find at www.conservationfinancenetwork.org. Last but not least, be sure to check out the CBAY website and newsletter for more information on upcoming webinars. Until next time, this was Corey Scult from the Yale Center for Business and the Environment. Have a great day.